We are back with more My Southern Home, and I'm here with Jeff Ratanapool with Stockton Mortgage. And Jeff, I'm so happy to have you back on the show today.
Happy to be here. Thanks for asking me back.
So one of the neat things that's going on in the industry right now is because the rates are a little bit higher, people are getting into creative financing.
That's correct. You know, it's interesting how consumers and mortgage lenders adapt to the changing environment. And, you know, it's been happening for years, but there are three that I really wanted to tell you about. So the first is an MI buyout. So a lot of people who are not putting 20% down have mortgage insurance. And so one of the ways to alleviate the high cost of mortgage insurance is there's a one-time mortgage insurance premium that they can pay for right at closing. And it's typically a point or 2 percentage points of the loan amount, but it forever prevents them from having mortgage insurance. So they pay it all up front. And so where someone's at 90%, instead of put 10% more down to get to 80% loan to value, they can pay 2 percentage points more and get rid of that PMI, and that will help lower the house payment. Because it's all about the creative way to make the house more affordable in an upward rate environment. So that's a big one we're seeing being utilized quite a bit. The second one is people are splitting their loans. So instead of doing one mortgage with PMI, they're doing what's called a piggyback loan. And so they're doing a first mortgage and a second mortgage closing simultaneously. And then that way, instead of having one loan over 80, they still borrow 90, but they do it as 80 and 10. So we call that an 80-10-10 and 80-15-5, but that helps them not have as high as a payment because the mortgage insurance is avoided. And then the last one, which is not really prevalent yet, but will be coming if rates continue to rise, are people are looking at adjustable rate mortgages. And so lenders have not had to use these since probably 2000. But how it works is it's still amortized over 30 years, and you get a discounted rate for the first amount of time that you want it locked in. So for example, the most popular loan is a 5-1 ARM. And what that means is it has a 30-year term, but your interest rate is only locked for the first 5 years. It's fixed for the first 5 years. And so if mortgage rates are at 6, then you might be able to get that at 4.5 or 4.75. It depends on your credit score and everything else, but ultimately you get that lower payment for the first 5 years of the loan. Now, people don't panic because there is no prepayment penalty, and any time in that 5-year fixed period where rates are low, if they come back down again, a person can refinance and go into a fixed loan at the same rate. Or if they got to the end of the 5 years and rates hadn't changed, they could refinance to another 5-year fix. So there's multiple ways to finance the homes that are creative and can give people some payment relief if they're trying to get a lower payment than just taking the standard old mortgage.
Well, and it sounds like too you have some ease of mind, especially with all those different options. So tell me a little bit more about the ARM, because that was something that I did when I first purchased my condo, and I want people not to be scared about it because it's not a balloon payment. There's two different things.
Yeah, so all ARMs have what's called caps, meaning that there's a limit on how high the interest rate can go or how long it can take to get there. And so most secondary market mortgages have a cap of what's called 2 and 5. And that means that it can't go up more than 2% in any year from the previous year, and it can't go up more than 5% over the life of the loan. So at Stockton, we try to put ourselves in the shoes of the borrower. We understand their anxiety and maybe their fear. And most people's fears of an adjustable rate mortgage is the rate will go up and stay up and they'll no longer be able to afford the property. But we show them right from the beginning, look, if it were to go up over the highest point it could ever go, this is what you would pay. And that's called the worst case scenario disclosure. And when we establish that, most people take a sigh of relief and go, okay, I could handle that. You know, it might be tight, but I could handle that. And then we explain to them how it doesn't go there from year 5 to the next adjustment. It would gradually get there because there are limits that are put in place in the program that say it can't go up or down more than 2 points in any given year. So they even have the potential, if rates were to drop and they stayed in that adjustable rate mortgage, that their payment could go down if they happen to catch it at a time when the interest rate went down.
Well, and if there's no penalty, they can always refinance and lock in a lower rate. And then there's no worry about that adjustable rate at 2 points.
And you know, we explain to them, you will have to pay to refinance and you'll have to requalify, but absolutely you can refinance at any time. And I think the most interesting thing about the adjustable rate mortgage is the average life of a loan in the United States is still only 5 years. So even though people buy a home and get in a loan and think they're going to pay on that thing for 30, the majority of people are in a new loan, whether they've sold or refinanced, within 5 years.
So let's talk about the piggyback, because that is a loan term that's completely new to me, and I think that that is so interesting.
So it was highly popular in the early 2000s, and then when the meltdown happened, some of the larger banks just pulled that back because they were in second lien position, and when the house prices dropped and people unfortunately lost their homes, there wasn't any money left to pay those second mortgage lenders. So it took them a while to come back, but from 2018 till now, that market has gotten heavy again. So ultimately, what the lender does, usually it's a home equity line of credit, obtained at a bank or through the secondary market, and it closes at the same time. So let's use like simple numbers. Let's say your house is $100,000 and you were going to borrow $95,000. So instead of doing a $95,000 loan with PMI on one rate, what we do is we loan them $80,000 on a 30-year fixed at the market, and then we bring a loan of $15,000 in from that home equity source. So the combined loans together are still 95%, but there's payment relief. A, the 80,000 is less than 95, so that first fixed payment's lower, and B, that second mortgage is an interest-only loan, and it's still cheaper than if they just did a fixed and paid mortgage insurance, and both are tax deductible. The interest is tax deductible.
All right, well, thank you so much, Jeff. I really appreciate it.
Thanks for having me, Kimberly.
We'll be back with more of My Southern Home in just a moment.